Hi, my name's Dane Pymble,
Hello, and my name's Aadil Abbas.
and welcome to episode 3 of the Normless Performance Series.
All right, pleasure to have you guys on. Thanks for joining myself for this episode, Dane and Aadil. We haven't really had anyone in the financial space as of yet, so it's really exciting for me to get branch out into another niche. And I've got plenty of questions today lined up that I can't wait to ask you guys about. But yeah, we were just chatting there before, Dane, and it's been a long time between drinks, hasn't it, mate?
It has. I remember a very young Hayden back from my time at Warringah Cricket Club, and I guess anyone listening, if you want to do life on hard mode, become a leg spinner because it wasn't the easiest craft. But suffice to say, I've kind of gone on past my time there. Didn't end up playing for Australia, so had to find a new career.
Yeah, I think it was good time down there at the cricket club. I think for me, it was when you're playing on those weekends, you really don't quite understand what an investment of time it is to play cricket. It's not like, playing football or soccer where you have those couple of 1 hour trainings per week in the afternoon. I know that's for a social, if you looked at professional
Sure.
athlete, it'd be a lot different. But when it comes to cricket, you got your Saturdays booked out, your Sundays, your 4 hour
Sunday's
bench
recovery.
sessions, and you're drinking after with the boys. So yeah, it's been a while, but I think back then I was a lot more immature. So to have grown up a little bit now and have a more sophisticated discussion should be interesting.
Yeah, likewise.
And Adil, welcome to the podcast. As I said, pleasure to have you guys. Now you moved to Australia around 20 years ago, um,
Yes,
and this was at a point when you were transitioning into a new career. It sounds a little bit paradoxical, but it was almost like the goal-orientated investment habits, which we're going to talk about today, that you developed during that time, was almost like the beginning of the commencement of your new career, and helped you leverage time to create a life for yourself. So can you tell us a little bit about your background and where you grew
sure,
up and how you made your way to Australia?
sure, Hayden. And as Dane said, in a way, pleasure to be here and thank you for having us. My journey to Australia was 20 years ago. I moved to Australia from India, having lived in different places around the world, having been, I would say, lucky enough to have lived in different places around the world whilst growing up. So, India, Dubai, Switzerland, Singapore. And in fact, my goal for coming to Australia at the time was, and I think as you alluded to, goals have always been important to me in my life, and I've lived my life by having goals and milestones along the way. And the goal at that time was to actually go to a country where I didn't know anyone. Interestingly, it was so I opened the map of the world one day, spoke to my parents, and I said, "Where do we not know anyone?" Because we were as a sort of family, we kind of have we know people all around the world, and they said two choices: you have Australia and you have, let's say, Canada. That made the choice very easy. Of course, I'm coming to Australia. Who's going to go to the Canadian winter? Who's going to bear the Canadian winter? So I said Australia it is, and I enrolled myself at a master's program at UNSW just to kind of make my transition into Australia, understand the Australian sort of landscape, the Australian environment, and sort of things like that. And from there on began my journey into Australia, and I found myself, and I felt instantly, to be honest, I felt that within a couple of months of landing in Australia, I felt very comfortable. Oh, yeah. So I felt very comfortable instantly, and decided to made up a goal of myself that I wanted to live in Australia on a sort of a permanent basis, and then went down the typical skilled migrant route to try and forge a life for myself here in Australia.
Were you one of those people that growing up you just had innately good, saving habits? Some siblings are on the flip side of that coin. They love to spend. They're always on afterpay. Like that was my sister. Just always asking for money from mum and dad, whereas I was always putting it away into a savings account. Were you or were growing up? Did you always have those, strong saving habits, or was this something that you kind of, like Dane, which we'll talk about in a moment, kind of had to develop through your own research and reading?
So mine was actually interestingly. So I would say lucky enough to grow up in a sort of a family where money was not really an issue. However, I very quickly realized, for me, the biggest realization growing up around my family and the people I knew at the time, that money by itself was not making anyone happy. So I kind of actually developed an aversion to kind of speaking too much about money and investing and things like that. In fact, the first book I read was a balance sheet. I would say, like, that's the first book which I read was an annual report. I knew, because I was surrounded by financials and money all the time. So in fact, I actually developed an aversion to actually talking anything money related, because money was never an issue. It became those things which I thought in my family was one of the reasons why it didn't bring people together. It actually took people away from each other. So mine, yeah, and for me, I developed a very different attitude towards money when I was growing up. For me, it became very clear. Money is just a means to something else. And I started to focus more on what is it that I want to do with my life, because money is fine. It is what it is. If that answers your question in one way.
And so studying in 7 countries, you were in India, Dubai, Switzerland, Singapore, global citizen. Now we're going to talk, as I said, we're going to talk a bit about Dane's upbringing and his career, and Dane, you could probably answer this as well, but how much of a benefit was that, partnering with Dane, you bringing that broader insight about maybe what the economy is like around the world and your own experiences abroad? How has that impacted you guys now moving into your partnership and business with Own Financial Planning?
Sure. I might talk to that one, Aadil, in terms of how we came together, and then obviously, yeah, you share your version, but it's certainly been fantastic in terms of my aspirations as to what I was trying to build, to have sort of partnered up with Aadil. I guess at the time I was involved with another business. Whilst there was sort of the aspiration to create this goals-based financial planning business, the main focus was more purely around funds management. And so there started to be sort of a disconnect in the vision there. Coupled with that was a need to have more structure and process built into the business. And so I kind of started to look around and I guess I got a lot more than what I was looking for. If I'm being honest, I was looking for some admin support, fundamentally just admin support initially. And it was it was during COVID, and at one of these kind of online networking, speed dating style things that were running at the time. I met Aadil, and we kind of clicked really quickly in terms of, it was clear to me that he understood what it was that I was trying to work towards, but he was coming very much from a purist sense in terms of what true goals-based financial planning is. I'd been very much heavily influenced from my funds management background, and it's been a really great experience working together with Aadil in terms of evolving the way I've approached advice, but what we do now collectively as a business, centered around sort of starting with the life that people want to create and using investment strategies to help achieve that, rather than focus on our investment strategy is going to perform better than this other one, so you should put your money with us. I mean, it's all well and good to have investments do well, but it's for what purpose that they're working towards that's the most important. Do you want to add to that, Aadil?
No, I think that's what you said, Dane, was very interesting over there about the fact that how we kind of came together. Of course, I didn't myself know what I had in a way signed up for by deciding to work with you. So it has been a journey for me as well. But I think, to Dane's point, it was very much, I found in Dane someone who actually had strengths in areas where I did not have strengths. So for example, the investment management part of it, I understand the importance of having an investment strategy. I understand that clients will anchor into numbers and into performance and stuff like that. So having somebody who can talk to that sort of confidently was important for me, because I kind of I knew in my heart that it wasn't the true value of the service I wanted to deliver, but it had to be an essential component of the service. So having a business partner who actually could manage that side of the business was important to me. So Dane was the person I felt, yep, we can, and he understood. He was trying to already build a goals-based advice business. My entire life, as I mentioned at the very beginning, was all around like goals have been. I've always lived my life through goals. I've given myself 5-year milestones, 10-year goals, and things like that, and I've always worked towards achieving them. When I met Dane, essentially, I had been in Australia for 20 years by then. I'm a product of, I would say, goals-based financial planning. I used to work with a financial planner who had a goals approach. And having taken that approach for 20 years after moving to Australia, it gave me choices in my life. And I thought, that is wonderful. It gave me a choice to say, do I still want to be doing the job which I was doing at the time? I was in management consulting. I was doing pretty well, I would say, at that time. I could have continued down that path. But then I was like thinking, if I have a choice in my life, do I want to spend the rest of my life doing what I was doing at the time? So having had that moment of realization, or I would say a moment of realization to say, you know what, as a result of my goals-based financial planning approach, I have now choices in my life to design a life which will allow me to lead my best life. And then I decided to then become a transition into becoming a financial planner myself, and was looking to partner with an individual who kind of shared a similar mindset and approach and wanted to build something as well, which was a different sort of a financial planning value proposition, which is what we are now building at Own Financial Planning, which is about helping people design their best lives.
Yeah, and so Dane, you in your early days, you were quite open about the fact that you were quite pessimistic about wealthy people or the upper class in society. So what caused you to kind of change your mindset or your trajectory towards that goal-based wealth management?
It's really, I don't know, it's really weird sort of looking back and reflecting on it. I grew up in a middle class area, Northern Beaches of Sydney. You know it obviously very well, Hayden. But always felt like we were working class. I came from a working class family, and I guess it was resentment, I guess. The other kids, or the other kids had the nice clothes and all that sort of stuff. You look back now and it's very vain or very silly, but it certainly at the time shaped the way I saw the world, and at that time it was like, well, I was born into this life, that's the way it's going to be, and there's no way of getting out of that. Thankfully, I guess in my early adult years, I can't even remember how it could have came about, but I sort of did some personal development courses, and through that, it really sort of changed my outlook on finance, but also just life in general, in terms of if you work towards something, you can achieve it. And it's not just about the goal that you have, it's the process that you need to go through step by step to get there. And some of the early aspirations that came out of that was this very strong desire to build a business and develop sort of that entrepreneurial skill set. So that was the origin of it. I didn't know what it was going to end up being, but I was very passionate about wanting to be building a business rather than working in a salary-based career for the rest of my life. That's kind of where it started. And I guess that the seeds of that have kind of manifested into what we do now in terms of goals-based financial planning, at least from sort of my contribution to it. That Aadil talks to himself being a sort of a product of good goals-based financial planning. It's been more of a challenging path for me, certainly, in the sense that I'd say when I advise clients now who has aspirations to start businesses, I'd say first and foremost, get your personal balance sheet right. Build yourself a passive income stream so that when you do embark on this passion to go into business, you're doing it from a solid footing. So you've got a really good runway. You can really apply yourself. And I'd say I went earlier into this world than may have been optimal, but I wouldn't change it. It's been a great experience along the way. But but certainly it influences how I advise clients with similar ambitions.
With the pessimism side of things, do you think this kind of mainly comes from people's misconceptions about money? And you know,
Yeah.
you have to be an expert to be able to invest in the stock market. You know, like they don't know about exchange traded funds, and it's all about, you know, trying to beat the market and that kind of thing. What kind of misconceptions do you see and hear most from your clients that own financial planning?
Sure. I mean, one is that, yeah, is getting caught in all of that noise and focusing that, you know, we in a lot of the workshops that we do, we show this sort of image of a seesaw where the top end of the seesaw, where most of the energy is often focused, is trying to find the perfect investment, whether it's property, shares, crypto, or private equity, or whatever it happens to be. And a lot of people fixate and put all their time into that at the expense of some of the more fundamental things, like having good sustainable savings habits, having your assets structured in a way to pay as minimal tax as possible. All the, in some regards, boring stuff, but even more important than all of that, the purpose or the goal as to what's driving those investment decisions. It sounds almost cliche, but often that gets jumped past, and it's the most important point, is that, and it could be things like you want to build wealth so that you, at a point in time in the future, you're generating enough income from those assets so that work becomes optional and you're not dependent on your salary to fund your lifestyle. That's a very common sort of long-term target that many of our clients work towards. And I guess and then probably one other point on that, one of the other sort of misconceptions, I guess, is the need to have it perfect before you do anything. Is that doing something, albeit imperfect, because you can't predict the future in your own life, let alone what markets are going to do, as much as we aim to, is the just taking some action from wherever you find yourself moves you forward towards your goals. It's going to put you in a better position than doing nothing most of the time. Conversely, though, sometimes along the way, doing nothing in some areas of your wealth creation may make sense. Just consolidating some of the assets that you may have bought along the way. So the last point I'd sort of want to make around all of that is just the ones that kind of get the best out of it are those that have a willingness to be coached. It's not that there's this dark, mysterious sort of knowledge that we've got access to that everyone doesn't. It's more just the structure as to what to focus on at what times, and that accountability to stay consistent with what it's going to take to get to your goals. No different to how any professional sports person engages a coach, even though they're very well qualified in their skill set already.
Yeah, I guess that the novelty in your story, Dane, is that you entered the finance industry at the age of 20 without any formal education.
I was an apprentice greenkeeper.
You read a lot of Warren Buffett's books and educated yourself. But Aadil, on the other hand, you're complete other side of the spectrum, multiple university degrees, different countries. So I guess my question is, when you came together for when you guys came together for own financial planning, you had this co-advice model, and you were very focused on achieving goals as opposed to investment performance, which is kind of the crux of what we've just been talking about. Was this something that you found that Warren Buffett was talking a lot about, or was this something that, you know, is kind of coming through in a lot of the messaging that various lecturers throughout different universities are educating their students on? What's the kind of trend at the moment in terms of the approach for long-term investing based on your two kind of differing experiences in life?
So I'd say over there, Hayden, from my perspective, I think what is really starting to come across to a lot of people is that when it comes to money, we are not rational. We are actually very emotional about our money. So people sometimes have this sort of people think that they're very rational about their money decision, but in fact they're not. And it's actually very emotional. You have an emotion and then you try to rationalize it through your money decision sometimes to kind of get to that fulfillment of that emotion. And so we try, and that kind of becomes very, it's something which we try, and of course we would like to talk about that to our clients and understand what is the underlying emotion. It goes back to the why of why you're doing something. So that is one thing. And then the other sort of thing which we try to do is, one philosophy which we have is like, is educate the client that financial planning is a continuous, I would say, process. It's not a transaction. It's a journey. We are on a journey with you. And the aim of the journey over a period of time is actually to be less wrong than to be precisely right.
Which is a classic Warren Buffett saying, that he'd rather be approximately right than precisely wrong. Now, he's obviously talking about how he invests in that context, but it's exactly the same in terms of the broader the broader impacts of that statement in any endeavor in your life, be it money related or whatever. But it's never going to be precisely perfect unless you're an engineer who
It's really important.
who ironically struggle, pardon the stereotypical comment, but often they struggle with the notion of that imperfection. And when we're working with people of that mindset, it's aiming to get them out of their head that things don't have to be perfect all the time in order to take action. And the last point on that, Hayden, around sort of where the origins, when I was sort of pouring myself through reading everything that's been written on Warren Buffett, it was very much when my headspace was very much focused on investing. However, sort of looking back now, a lot of the things that he talks about as to the way he invests money in Berkshire Hathaway is not how he would encourage someone starting out or someone early in their journey on investing. He has far more sort of simplistic views of that, which is to Aadil's point, is do something, albeit imperfect, but keep it as simple as possible as well. So, stick to investing in indexes rather than trying to pick, the best performing stock or asset class or whatnot.
I'm really keen to get into that because I've got a handful of questions from both myself and the listeners that we're going to ask you about. A really intriguing area of the market, which is continuing to grow. There's so many thematic ETFs out there now, and it can be really challenging for new 20-year-olds entering the market, trying to save for a house, where to put your money to get the best returns and that kind of thing. So, but I guess on that topic, success, feeling a sense of success, but also having some hardships throughout your career. So you managed an investment committee. You managed an investment committee worth $1.5 billion when you were working at one of the big four banks, which was really, no doubt, educational process for you. You learn a lot. You also went into then starting your own boutique fund manager in your 30s, like a little small business you're running there, but that didn't really quite work out for you. I guess coming from seeing when things are good and when you can make a lot of money and your progress is going strong versus when you are struggling. When it comes to, I guess, what you're doing now with Aadil, what kind of gave you the confidence that this was going to succeed, own financial planning? What was it that made you guys confident that in your own abilities that you could build something worthwhile together?
Sure. At least sort of from my perspective, I guess that the boutique business that I was a part of, I was very young when and the investment committees. I was very fortunate early in my career to have got opportunities to be part of, be involved in things that typically take a lot, take a lot longer in time to typically be involved in. But that business, we ended up selling it recently. I left it operationally sort of 6 or 7 years ago. I was never sort of the main person there. I was sort of supporting other people who had established client bases, and I, we built the operational structure around that. So in some parts it worked out. In other parts, it wasn't kind of the full realization of what I was trying to achieve. And I guess, you know, where we are now is I've found, not to completely discredit other people that I've worked with along the way. There was just differences in vision, and I think that only worked itself out later on after the business was established. And so it was when I came together with Aadil, at the beginning, it wasn't to start a business together. It was, Aadil was looking to, enter the industry after having a successful career in management consulting. I was looking to, expand what we were doing. But very quickly, it was clear that we had a common vision as to what goals-based financial planning should be. And so that, I think, is fundamental. You can't predict the future, so I'm not going to pretend to suggest that it's going to be perfect. It's going to play out completely as you would expect it would. But it's a fairly fundamental principle, I think, that creates successful businesses is having a common vision. And the other thing that's tied to that, and this is where I really have to hand it to Aadil, and you can talk further on this, is having really clearly defined roles and responsibilities within the business, albeit small, and you got to wear a lot of hats in a small business. But just being really clear in understanding each other's skill sets and allowing that skill set to thrive. Sometimes when you're a sole practitioner and you bring on a business partner, you can have the right intentions, but it can be challenging to let go of things that you're used to looking after. But you've got to sit back and think, well, I've brought this person in because they're good at what they do, and I'm good at these other areas. And so for that to work well, you've got to allow each other to thrive in the areas that your respective skill sets are. Aadil?
Yeah, and for me, Hayden, I would say that management consulting was a wonderful training ground. I feel those principles which I learned on being a good consultant gave me the confidence to kind of develop certain principles around work and business, which I have tried to translate at Own Financial Planning with Dane, and Dane aligns to those principles. And some of those principles being like when you're in management consulting, it's like you have to try and put I would say, customer at the center. Everything has to be about the customer and the client. They are the ones paying your fees. So everything is about it's really the heart of your business has to be the customer, not your strategy, not your beliefs. It's the customer. What is it that they want? That was one key skill in management consulting. Secondly, the ability to then learning how to influence people, because management consulting is about influencing clients to take certain decisions. You are an external party giving them an objective advice. Similar principle in financial planning. We kind of are the third party to our clients in financial planning to give them objective advice around their money, like striking a balance between the emotional and the rational stuff. Thirdly, I would say it's about just play to your strengths. Like that's what happens in management consulting. You put together a team of people and everybody plays to their strengths. With me and Dane, that's what Dane kind of spoke about a bit earlier as well, is that we have very clearly identified each other's strengths. We know each other's weaknesses in the business, and we play to our strengths. We don't try and we definitely try and do that on an operational level so that the business can thrive. And then finally, one thing which I learned in management consulting as part of just having been part of so many teams and being successful in that career is be willing to do the work. Talk is cheap. Talk is cheap. You've got to be willing to do the work and put your head down and just do the work. And those are the 3 or 4 key principles which I apply, which applies to clients as well, that you can get a plan from us.
Yeah.
Then we will be willing to implement the plan. Go ahead and implement the plan. Do the work. Otherwise, it's like getting a plan on a piece of paper is worth really nothing. It won't change your life. It's when you implement and do the work.
In some respects, Aadil, on that point, it's kind of like signing up for a gym membership but not going to the gym.
Yeah.
And no one more so than me needs to sort of work on that part of my life. That's something that this year that I've done is, and I kind of put myself through our clients' process as a guinea pig to to experience it as a client, to truly understand what I'd be looking for in the service. But two, it's that classic case of many tradespeople and many professionals are the same, is that you spend your whole career working on your skill set and being of value to your clients, and then you don't apply the same principles, or you don't have the time, you don't allocate the time to your own. So this year I kind of dedicated that and sat down with Aadil, and we kind of went through the advice process with me as a client. And what became very apparent was investment strategies and whatnot was obviously sort of all okay, but it was the other areas that I'd neglected, the physical health and whatnot, that needed attention. And by putting attention into that, it was going to actually have benefit in all these other areas as well. So that's sort of, and it often comes up with clients. It's not necessarily a money related thing that holds people back in achieving their goals. And so we have a lot of people, a lot of professionals around us that we can tap into, whether it's a career coach, whether it's a mental health specialist, etc., to help our clients in different areas of their lives, not just their money.
Yeah, that just really resonate with that. I think a lot of people want that quick fix, don't they?
Yeah.
And one question I have for you is, do you find that people are coming to you asking you for the magic bullet, saying, give me the best ETFs to invest in to get the best returns over time, when in reality, it's really important you do your own research, because you might have an index ETF that tracks the ASX, but we know there's a whole variety of different ETFs that track that index.
Yep.
So the A200 or Vanguard Australian shares. So and they all charge different fees. They're very different. The VAS index tracks 300, the top 300 ASX stocks, where your A200 is only the top 200. So, someone going into that, they need to almost have their own objectives cemented.
Yes.
Before you can help them with determining the best investments for them.
Yeah, and to answer that, and Aadil kind of manages the client experience once people come on board. I spend a lot of my time at the front end with clients, and so to your very initial point on that is, we'll deliberately not take on someone that doesn't want to sort of engage in holistic advice. Not if they're coming to say, hey, I've got this much money, I just want you to find me the best investment. We just don't. There's plenty of people out there that can help with that. It just doesn't gel with the way we work. We want to understand the person and the life that they want to live, and the goals that they're working towards, which for some people, like, it's hard for them to conceptualize the importance of that. It's like, yeah, I get the goal stuff, but just tell me how to make money. And if that's the mindset, that's fine, but we're not we're not the right people for you. And then when it comes to what to invest in, it's about the fourth or fifth meeting that the client has with us. Once we've got clear on their goals, then we've understood their cash flows and their assets. Then we start talking about what the right investment strategies are. But we do that from the context of knowing what goals they're trying to achieve, and also what their values are, what's important to them. And so when you bring those three things together, then the right investment strategies just make logical sense, because that's the strategies that's going to help achieve that objective, and it's built around what it is that people value. And some people have a more of an affinity with the share market, others with property, others don't care. They just want the outcome, and they're happy to be guided by us on that. In many respects, like, the way clients engage with us in that way is different from client to client based on their interest and expertise. So, but you're exactly right, Hayden, is that when you're drilling into whether the nature of what portfolio you put together, it's contextual to the goals that they're trying to achieve. And I'd say some of that's the noise. And we've got, when we work with clients, we've got different ways in which we can manage portfolios for people, from just pure low cost index to more bespoke theme-based asset allocation strategies. But it's very much dependent on what the client is going to gel with best, because the best strategy is the one you're going to stick to. It's a bit like, again, it's a bit like dieting. All the diets work in their own way. You stick to them, but there's the fact that they all work. Some will have very evangelistic perspectives of one of them at the expense of all the others. That's not our style with investment strategies. There's many different investment strategies that work if you stick to it.
Just to add to that, Hayden, I would say the reason we kind of we don't start with giving people the answer which they're looking for. Like, that's the thing. It's like people get frustrated that they just want an answer to your earlier question. Is like, yeah, just tell me what to invest in, what to do. One of the reasons we find through our experience and through our own personal experience is the fact that no investing journey is going to be every investing journey is going to be volatile.
Yeah.
It's at the times of volatility is then when you have to anchor back and say, why am I doing it? Because most people actually are not successful in investing because they don't have a real why. They're just investing because that's what people around them are telling them to do. And they cannot stomach the volatility, be it property, shares, whatever you want to go down the path. And they will just unwind that particular strategy because then they don't know why they invested in that in the first place. And hence we focus so much on kind of trying to understand them as a person, their values, their goals. And then whatever strategy it ends up being, we are of course going to give you investment advice. We are of course going to give you specific things to talk about. But it's only when if we can give it to you in the context of your life and your goals, there's a greater chance you will stick to the strategy. You'll be able to go through the volatility and actually realize the value of that investment. That's the reason why we kind of focus so much on it. And that's how we tie all of this together.
Relatable to Maslow's hierarchy of needs, you need to satisfy those base fundamentals before you build on, self-actualization. That really good model to, I guess, frame what you just said there. Some of the financial advisors I've spoken to in the past, just talking to them over the phone, they've said things to similar to effect to what you just said there, Dane. A lot of them will get their customers to take out income insurance before they even start investing in stocks or property or whatever it be for them. So it seems like a common theme there that you need to cover your bases and set up that solid foundation before you start allocating your money towards these different shares, investments, property, and so forth.
Yeah, spot on, Hayden. And the way we sort of characterize that is kind of getting your financial house in order. The starting point that we focus on is helping people get really clear on their goals. And that's not just the long-term goals that you're working towards in terms of wealth creation, but what you want to do in the next 12 months and not just financially. It's the travel that you want to do, it's any sort of career ambitions that you've got that you want to work on, and all of those things interact with your money, part of your life. So we want to really clearly understand that, so what we end up mapping out is tied to the achievement of those goals. Then what we focus on is what we call the spending plan. So I guess the spending plan is, yes, another word for it is a budget, but it's a little bit more than like your traditional sort of, what are your sort of day-to-day living expenses. It's making sure that you're properly allocating for those luxuries that you do enjoy in life, in that whether it's travel, dining out, or whatever, all within reason, of course, but with the important notion that the present is as important, if not more important. It's the only thing that's real than that future that you're working towards. You don't want to completely sacrifice the present to achieve some sort of future goal that's yet to be determined. So we want to strike that balance there. So once we're clear on the spending plan, we know what surplus cash flow there is available to be able to invest. And also, because we know your goals and your values, we know by that point how you would like to invest and what it's working you towards. So that's the point where we start focusing on your assets. When it comes to debt, it can be a great tool to accelerate wealth when used in a smart way. And we want to tie all that together through essentially getting you structured without overcomplicating things, but getting you structured in a way to pay as little tax as possible. Obviously not pushing the envelope, but just doing it in a way that is logical, so that you are growing your wealth in the most tax efficient way. Where your comments around insurance come in is kind of what we call the roof of the house. So it's, essentially it's raining, but you're not getting wet. And so there's a few sort of key components to that. One of which is protecting yourself through insurance. And, it's not about, no one enjoys paying premiums for insurance, whether it's car insurance, home and contents, or whatever. But often by default, people will not necessarily happily, but have no issue in recognizing the need to have that sort of cover for your car or for your house. But often what gets neglected is, the thing that gives you those assets, which is you and your ability to earn. And so a lot of the time, particularly when you are using debt to accumulate assets like property, it's really important to protect your most valuable asset, being your ability to earn income. Not forever. It's not, you don't need to have insurance forever, because essentially if you're building your investment assets over time, those assets become your insurance. So it's something that, yes, you need to get in place early in your journey, but it's something that you should review along the way so that and everyone's got different philosophies on it. Mine very strongly is you have enough insurance, you have enough that you need to cover the gap. And no more. Pay as little as possible for it and as tax efficient as possible. Others like a Rolls Royce cover, and they want to be overinsured because they don't want to have to sell any assets if something happens. So,
and insurance has a bit of a legacy element to it from my perspective. So you always try and marry insurance and the legacy, because if you are saying that you want to be able to leave a good, by all the work you're doing on the investing side, you want to be able to protect it for the next generation. Then of course insurance becomes even more critical. You need to have the right, you may need to keep insurance for a long time, because you don't want to ever want to be able to, you would never want to be able to sell that asset. And I think people sometimes don't like, I think it's about showing them the linkage between insurance and leaving the legacy. It's, in fact, the insurance is because you want to protect it for the next generation. And that sometimes changes people's attitude towards insurance and why they should pay for it, or why is it important for them. So we have to we try and find, again, it goes, as you can imagine, Hayden, we keep going back to the same thing. If you understand your goals and your values a bit better, the strategies, be it insurance, estate planning, investing, debt, all can be really, we can make it really personal for you. We can show you why these things matter to you. We can show you, and for you, more importantly, you can believe in it, and you will be the higher chance you'll implement it.
We also show why it's kind of important that those all interact together. Is that if you go and just you can look, there's plenty of specialists out there and we work with them, is you can go and get insurance advice in isolation, but we feel it's much better that's why we deliberately only work with people that want to engage holistically, is that what you're doing with your insurance is influenced by what you're doing with your investing, and vice versa. So we feel it's important to be, reviewing them together.
Yeah. So just to kind of summarize what you said there, Aadil, in a bit of a snapshot. So basically what I took from that kind of is that when people haven't got, like, say for instance, with insurance, if it's not tied to the actual experience with the assets, so it's like car insurance or house insurance, if they're insuring their income, but they don't have this rationalization that if they lose their job, they're not going to be able to fund those things. They're less likely to invest money into that. They don't see the bigger picture, kind of like bonds or buying gold, and how people want to invest in the big tech stocks or pharma like CSL, for instance, but they're not willing to put money into the bonds or gold or cash assets, which is going to protect their wealth or income.
True. I think that's very true. It's about the disconnect people have that insurance is an expense. In fact, I would say insurance is an investment into your investment journey.
It's investment to protect the positive growth that you've had through your assets.
Absolutely. Yeah. Absolutely.
And so I guess trying to take a step back away from own financial planning, I know you guys, it would be easy to provide a bit of biased answer to say that Own Financial Planning is the firm to go to for all your financial solutions, but just trying to be objective with what people should look for or consider when they're looking for a financial planner more broadly.
And I think we might have mentioned earlier too, our style isn't for everyone. I think our style is people who are, who are goal oriented, who are clear with, or just need some guidance as to the next steps as to where they need to go to with their goals. I think fundamentally where financial planning helps is money is still it's a taboo subject a lot of the time. So even within households, it's often not talked about other than sort of, here and there. That and just it's often the thing, it's part of life admin. It gets put to the side a lot. And so no different to any other profession. We've talked about some in health or in medicine, you go to the GP to get a checkup and you get recommendations to get assistance in areas where you might need help. Financial planning is similar for the money part of your life. And so if you just want to work and earn a salary for the rest of your life and you're happy with that and you're content, then that's fine. But if you've got things that you want to work to and would benefit from some coaching along the way to get there and some accountability that comes with that, that's where we see financial planning as an industry helping people.
And if you're looking for a financial advisor, I think Hayden, my thing would be, my guidance to people looking for financial planners would be, I think maybe ask yourself after meeting with the financial planner, does this person really understand me? Do they have a genuine interest in me and my life? Do they have that? And then secondly, can I trust this person? And then over a period of time, hopefully you will get to, I would say, like them as well. So I think start with trust and maybe not with like. Do you like the person? I think it's about, because these are some critical decisions about your money and life. Finding somebody you can trust is always, because we are in the business of trust ultimately.
Yeah. So understanding, I guess, the broader picture about what your life looks like in the scheme of things and where you're going. Yeah.
That's exactly it.
So I guess one of the things that I've also found is that when you go to a financial advisor, and this is a couple of financial advisors I've spoken to, their personal anecdotes, but often they're much more routine and consistent with their investment strategies with their clients. And in their own investments, they can often be a lot more erratic or have a higher risk appetite for chasing individual stocks, trying to beat the market, as we spoke about earlier. So do you find that people coming to see you, a lot of it is like going to see a personal trainer or an exercise physiologist for that commitment almost, and that accountability factor as well to keep them on track rather than going off track towards those smaller cap stocks and things that are, almost like gambling, it's a mug's game trying to pick the market.
I guess I'd say it's gambling when there isn't a clear strategy and plan around it. All of those investments that you highlighted are fine in isolation as part of a well thought out strategy. And I think to answer the other part, whether everyone comes to us looking specifically for that's not always necessarily the case, but it's the value that they get out of it. And those that can, through the sort of initial discussions, those that can kind of perceive the benefit of that. And then we, as humans, we understand through analogy. So we often use that sort of personal trainer or GP analogy, is that in those areas of your life, that's what role that they play, and that's where they help. We are doing similar things for you in the money part of your life.
We talked a little bit about stocks there. We'll come back to that in a moment, but I want to get into a little bit of a debate about shares versus property. I've listened to various different podcasts. Everyone has very differing opinions, and again, I think it all stems back to what we said, that the individual, their goals. But I guess in the property side of things, I bought my first property back about in 2021, about 3 years ago or so now. But back then, the interest rates were, my fixed interest rate was about 1.3%. So for 3 years, it was beautiful, really cruisy. Now we're looking at interest rates, which are really high. Now, some experts are saying that there's nothing really to worry too much about with the property market, especially in, in places like Sydney, Melbourne, Perth, just because of the lack of property available on the market. And despite these high interest rates, that's really going to save us at the end of the day. What's your kind of expectations in the coming years about the bank's movements, and also what we can kind of expect in terms of the property market and where people should be looking to put their money, or what should they be looking to do with their money?
Who wants to take this, Aadil, or do you want?
I can go initially, just to kind of give some initial high-level perspective around this. It's like, we believe as an asset class, I would say property certainly does have a place in everyone's, I would say, portfolio. So that is something there. And again, the property market in Australia is not one market. It's a divided market. Each city will have its own sort of, I would say, cycles. It's about understanding, where does this particular asset fit into your overall portfolio strategy as an asset. I think that's number one for us, is like, where does this fit? Secondly, it would be around, do you have the cash flows to be able to, I would say, sustain it? Because, interest rates, we can't predict. We may have a view to say interest rates are going to plateau, they're going to come down, they're going to go up, but that's not controllable. What is controllable is your cash flow. So again, we would go back to saying, do you have the ability to stomach the volatility of any property journey, which you just mentioned right now. We went from 1% to 6% interest rate. If your cash flows are not strong, you'd be forced to sell the property, which is what we wouldn't want to do. We wouldn't want our clients to ever unwind a particular strategy. And in terms of where people should go, I would say, in terms of where we get clients asking us this question all the time: property or shares? Personally, I believe, as a philosophy, home ownership is a goal which everybody should have, because the emotional benefits of home ownership far outweigh any sort of, I would say, material gain. So at least buying your own place of residence is something we would always encourage our clients to think about as part of their investing journey.
Sure. And maybe to sort of add a few points to that, in terms of shares versus property, in the super long term, and we're talking decades plus, the long-term returns for the Australian share market and residential property are pretty similar. The capital growth that you can achieve and the income. The journey is very different. Shares, as we saw through COVID, for example, in the recent time, they dropped 30% in 3 weeks. That had never happened before. But shares on a day-to-day basis have greater volatility than property does, and so we don't have a bias between the two, though. The answer to the question could be both, if it makes sense, and it could be a case of, in what structures does it make sense to own your property investments, and in what structures does shares make sense? A lot of the times, we're building wealth for clients through property outside of super, because of a lot of the tax benefits that you get from leveraging to purchase property outside of super, particularly for high income earners. And we're doing more of the share investing through superannuation, where it's at a lower tax environment. You get the benefit of the franking credits associated with Australian share dividends and whatnot. But as investments in their own right, they are both suitable. And in terms of forecasting, it's not our game, but I did come from this world, and I still indulge in it. It's part of what we do. I'd say we've come through a really tough period from COVID, rising interest rates, and there's an almost sort of inbuilt perception that things are going to be tough for a while. And I'm a big fan of the quote that if it's in the news, it's in the price. And so if the general consensus or the general sort of news that you're exposed to is relatively pessimistic, you can, without being able to guarantee it, of course, but you can feel optimistic about where investment markets are going to go, and vice versa. When everything's rosy and everything looks like it's going to be great for an extended period of time, it's probably already reflected in the market price. When we saw that, Trump in 2019 or 2020 gave one of the most optimistic, you know, state of the union addresses about how strong the US economy was, etc., and how great the jobless position was, and then we had COVID, and then we had recessionary environments, and then conversely, you go back to the GFC when Barack Obama gave a similar State of the Union address during the midst of the GFC with a far more somber tone as to how things are going to be tough for a long period of time here. Yet, fast forward from 2008 to 2019, you had quite a long period of growth through that period of time. So we're here today, sort of coming out of the lows of 21, 22 in the equity markets, and property bottomed in most cities in Australia around October 22 as well. Relatively optimistic. But at the end of the day, where we come from is whether there's optimism in the short to medium term with equity markets and property markets. Ultimately, it's not saying it's irrelevant, but a good strategy should be able to sustain good or bad conditions in these markets. They are long-term investment strategies. And to Aadil's point, if your cash flow is well under control, you can navigate those periods through market cycles where things might be more difficult, and they've been no more difficult for property investing than they have been in the last couple of years with such a significant rise in the level of rates where they're at now is not that high relative to history. However, it's the rate in which they increased from where they were that is very abnormal. It'll probably settle down now for a period of time, but irrespective, get cash flow right. What happens in the markets doesn't matter anywhere near as much as we tend to fixate on.
For young people in particular who don't have as much disposable income or don't have as much savings, determining where they're going to put their money, what would your advice be for these individuals, particularly if they're trying to save for a home loan deposit?
You want to go that one, Aadil?
Yeah, I think again, Hayden, no, there's no one standard answer for this. I think young people, when we work with some young clients, we focus on them developing good habits.
Yeah,
it's habits towards money and the attitude towards money. That is the key component at that stage of your life. If you can kind of do regular budgets, you can live within your means. You don't kind of spend more than what you earn. You kind of then work towards one goal to start off with, be it to start investing in shares with some lump sum or buying an ETF or buying a property. But it's good habits is what we focus a lot on with our younger clients around that. And again, because if it's a long-term investment, as Dane was mentioning, in the long run, property or shares will give you the same return, but it's your ability to stick to that strategy which will actually realize a return. It's not the asset class itself. It's your ability to stick to a strategy, which is what younger people need to understand. It's a journey, and it's not a transaction. So shifting the mindset from transaction, like journey to transaction.
Yeah, I think I was pretty fortunate with those good habits early on in life because my parents set me up with I think it was Dolomites or something when I was in primary school. And then throughout like high school, I was getting into dollar cost averaging and that kind of thing.
Right.
With my parents and that. And I think I really saw the benefits of that throughout that period where we had the stock market crash, because you could see like the reason why you invest consistent amounts at consistent intervals over time. So it tracks that basically over time, the index. Whereas if you're investing sporadically large sums of money at irrational times or at irregular intervals, then you would likely see the implications of that more. So I agree 100%. And that comes back to what you said with the developing healthy habits. And fortunately, my parents and that, they got me into like the top 2% of savers for my age when I bought this property. But I don't think that it was because I was, I wasn't any better off than any others who'd finished uni and found a job. But it was because of those saving habits that I was able to enter that 2% and get a really good.
So true. And so true, Hayden. And I know I talked about my headspace when I was of a similar age. And that's, if I what you just said is the key. Yes, that it matters far less than we want to pretend it does where we come from. Not to say that there aren't elements of society that it is really very tough. I'm not dismissing that. But for a lot more people than actually do, and congratulations and hats off to yourself for those habits that you did form. It it is that wherever you find yourself, whatever earning capacity you have, there is some positive things that you can do that move yourself forwards, and it's that habit formation that has the highest multiples of return on investment relative to any specific investment in and of itself. That habit formation is the most valuable asset that you can create at an early age, and it's really that's our challenge as advisors when we do work with younger people, is instead they either already come to us with it, and often we tend to attract those that do, because they're now at a headspace where financial advice is valuable to them. But for those that do need that assistance, that's the key part that we work on first, because we know that that's going to pay off year after year after year. And we also know those in their 40s, 50s, and 60s that haven't developed those habits, they know for sure they wish that they had it in their 20s and 30s. And so it's just impressing upon that via analogies or via case studies and whatnot, the importance of that, to not skip that step and jump straight into investing, which is the sexy sort of fun stuff. It's develop that habit formation. It might be just commit to a savings plan for 12 months. Just put money away. It could be as simple as that. It doesn't have to generate a return necessarily beyond just the interest on cash, but instilling that habit will pay off in spades for the rest of your life.
A lot of people, sorry, Helen, just to add over there, a lot of young people have this idea of that it's about motivation. I would say motivation is overrated, habits are underrated. So people should try and not talk about I'm motivated to do it. I'm actually building a habit. And if you can just change that mindset of, that is where I think we work with our clients a lot on, is like habits are like it will come and go in terms of your motivation, but habits will stick.
I think one of the important reasons to share that kind of anecdote on my side of things is, now I wanted to put it back in your ballpark, just to talk about some practical tips for young people to actually take away from this podcast, because it's all well and good to sit here and listen along to what we're saying and, oh yeah, Hayden's done this and that, this is Dane's advice, this is Aadil's advice, but something they can actually take away and integrate tomorrow or today that will help them in 20 years' time. So for me, one thing that's really helped me has just been that automated investment, which you can do with a lot of your brokers now, whereby you don't even have to do anything. You can set it up so these automated small investments going out of your account at regular intervals, fortnightly or monthly, which can actually do all of that dollar cost averaging for you in the background without you even having to worry about it. All you really have to do is just work out what you can and can't afford in terms of that investment amount. Do you guys have any other tips with regards to, say, that dollar cost averaging? And even if you want to just explain the concept more broadly for the listeners as well.
Sure. Do you want to go, Aadil? Or?
No, you go first, Dan. I will speak about another tip.
Yeah, sure. So maybe I'll start with the last part of your question, Hayden, in terms of just explaining dollar cost averaging. It's basically recognition that the investments that you're making, they go up and down in price over time. And we've talked about things that sort of happened in COVID and whatnot. And dollar cost averaging is essentially just setting a certain amount of money that you're going to allocate to that investment on a regular basis, could be monthly, weekly, or whatever, and just taking whatever price that investment is at that point in time. And so what that means is that during the ups and downs of the market, you're consistently adding to that. Sometimes it's at the higher prices, but you're also picking up the lower prices. And it's just a mechanical approach that over time builds wealth in a consistent way. In terms of, I'm probably going to steal some of Adil's thunder, the practical tip beyond what you do with your money is the step before that, which is have a goal or goals that you want to work towards. They could be whatever they happen to be, and they'll change over time. But simply just seeing investing as a good thing to do is certainly better than doing nothing. But when you tie that to a specific purpose that you want to achieve, it gives you a much greater chance of sticking to it and achieving success with it. So it could be saving for a deposit to buy a property. It could be something lifestyle related. It could be saving to go on a holiday, whatever your sort of cash flow is dictating. But the specifics of the goal is not as important than the goal, just having a goal itself in terms of formulating the habit and having a purpose to drive the action. Do you want to add to that, Aadil?
I think that's a great tip. Then the only thing which I would say, Hayden, is to answer that question around one practical thing people can do, take away, is I would say make a budget, make a spending plan, get aware of where your money is going, where it's coming and going, and that's it. That awareness of how your money's inflow and outflows are happening can by itself cause a lot of change, and can help you be a more successful investor, saver, in this journey. So I think just make a budget, spending plan.
There's plenty of free ones out there. If you Google Money Smart Budget tool, it's a free tool that the federal government sort of have. It's an online based tool, and it's very sort of interactive and very, very simple to put together. And that's a great starting point to kind of know your true sort of ins and outs, but also design the lifestyle that you want to live. You want to say, well, I want to do these sorts of activities, or I want to be able to travel. So I've got to make sure that I'm not going to be traveling every pay cycle. So I've got to make sure I've got to put a portion of my pay aside for that longer term savings goal. And then conversely, that potentially becomes a goal that your investing money is working you towards as well.
I guess one of the things that I've kind of worked out as I've started investing has been, it's also not just about how much money you have to invest, but also the personality type you are. So there's people who are much more patient, and there's others that are very emotional. And so I think, do you have any words of advice in terms of exchange traded funds versus small cap stocks, index ETFs? What would be your advice for those different, I guess, personality types, and what makes the most sense?
And I use the sort of Warren Buffett analogy, because the way Warren Buffett's built Berkshire Hathaway, a very successful company that's generated enormous returns over probably a 60-year period. The types of investments that he makes is not what he would be doing if he was starting out. And his advice is something that we would echo, is just keep it simple, and you get to make mistakes along the way. So again, it's tied to that habit formation. Just create the habit, even if the investments perform well or not. Just creating that habit is going to hold you in good stead. But without with all the usual disclaimers around personal advice and whatnot, you got to understand the needs of the individual. But we would lean towards just simple index ETFs. There's many different products out there. We're not here to endorse anyone over the other, but some just have a good, broad, diverse asset allocation to a high growth strategy or a growth strategy that gives you good diversity across all of those markets that you've talked about in a sustainable way. And those types of investment products are not dissimilar to what your superannuation fund, if you haven't touched it, would be investing in as well. So we would just keep coming back to, more important than whether small caps are better than index ETFs or gold or whatever, without trivializing it or being too flippant. ultimately, at the early stage, it doesn't really matter. The difference in return with the amount of money that you're starting out with won't make a meaningful difference in the super long term. It's creating the habits, and you'll find the things that you resonate with along the way. But again, without sounding like a broken record, hopefully, it's create get your cash flow right. So, spend less than you earn. That's fundamental. And then what you're allocating to investing, just be consistent with it for a period of time before you start chopping and changing. There's always there's always a great new investment opportunity, and always things that sound too good to be true usually are. It's just do something and stick to it. It's boring advice, but it works.
And invest in something which you understand. So that would be my principle. It's like when you make your first investment, invest in something which you understand, because that is going to make you feel empowered. You'll feel more confident. Don't listen to the market. Don't listen to your friends. Just invest. Buy a stock which you know something about from a company perspective. Buy an ETF which you understand, and that's it. Do your own research, but make sure you understand what you're investing in, and take some interest in it.
Yeah, I only hold a couple of index ETFs, which I'm really strong on. And I think that they're one of the issues that some young people make is they go into investing in different ETFs, but they don't have the proper education. They don't consult someone like yourselves to understand perhaps the overlap that exists there. As I said, like if you're investing in the A200 and VAS, and the IOZ, for instance, they all basically track the exact same index. And so they've all got that fee, that service fee. So you're basically wasting your money, right? Rather than just putting all your money into one of them. And as Dane said, it doesn't really matter which one you pick. It's just about getting started and chipping away at it's over time. I do have actually a tool, which I would like to share with our listeners, which I was looking at the other day when I was on the bike at the gym. And
Nice.
it was I've been listening a lot to the Australian, Rask.
Yes.
Sure. Yeah. So that podcast I listened to a lot. And the other one, which I think I noted on the last episode we did with Jeffrey Morgan, which was the Equity Mates podcast as well. Those two have been good for me. I listen to them literally routinely every day. But one of these tools I found, I think it was recommended by one of those podcasts. So I didn't find it myself, but was recommended. It's called etfrc.com. I'll put this in the show notes, but what I was doing when I was going through working out how to structure my own portfolio, I was using this tool, and you can pop in fund 1, fund 2. And basically what it does is it spits out all these statistics in terms of how much overlap there is in between percentage of stocks held within each of those ETFs. So I think that would be another good tool that people could use to, help them elucidate a bit more information about where their money is actually going. Because one example would be, say, IVV, which tracks the S&P 500, and then Qual. There's big overlap there, but if you hold them in the appropriate proportions, it can be still effective in your portfolio. So that's when seeking advice from someone like yourself, Dane, or Aadil, I think is really important. And that's why when someone comes to your door and they knock on your door and ask you for $300, like Jeffrey Morgan said, but you can't see the results of the service they're going to give you, people are very hesitant to fork out and give the money. But I think in this circumstance, there's that delayed benefit of, paying someone like yourselves to see that benefit over time through making the appropriate decisions in the short term. You can get those benefits in terms of your wealth compounded over time.
Yeah, it's spot on. I'll throw another one out there to complement that. It's something we'd like to check out. Actually, I hadn't come across that site that you mentioned.
I should note, Dane, I'm not sure as to how credible this software is as well. Just something I've stumbled across, which I used a little bit.
All part of the journey. Yeah, we were always looking to check out new tools. There's one that we came across recently called ShareSite. Why we like that, and it's a good tool for individual investors that are self-directed as well, is it helps you track the true performance of your investing. So obviously, particularly if you're doing it yourself, you're over time you're putting money in bit by bit by bit, and so the share site will enable you to input all the transactions that you're making. It can take feeds directly from your broker, if you're doing that, but it can track the true performance of your portfolio, not just each individual investment. So it works out, the annual returns that you're achieving, and it also enables you to benchmark that against an investment. So you might have an interest in small caps, or you might have an interest in different thematic ETFs and whatnot, and that might be how you want to build out your portfolio. And you can track that performance through ShareSite against, let's say, the Vanguard Australian Share Fund, or some sort of diversified growth index ETF or something like that. Whatever you choose, whatever benchmark that you feel is appropriate, but it gives you a good guide to say, if I just do a really simple thing and just buy this index ETF, what's that performance going to give me versus all these other things that I'm doing? Because they might be working for you or they might not be. The last thing on that, though, is measuring that over 6 months or 12 months is noise. Share markets have volatility, and so there's high variance. So you're not necessarily investing well if you're outperforming the market over a 12-month period. You might just be benefiting from positive variance. Ideally, you want to do this for a minimum 5 to 7 years. You can look back over that period of time. I know that's a long period of time, but that's in some respects the shortest period of time to measure true investment performance against some relevant benchmark. It's when we're assessing fund managers, that's the absolute minimum. We want to see them in business and performing in the themes that they have expertise in before we have an interest in sort of engaging with them, because it means that you've been able to sort of go through some different periods in the market. You won't be perfect. So anyway, back to the tool. We think it's a good tool for people that want to do it properly and measure how they're performing against doing something simple like just buying an index ETF will deliver them full.
I guess with the rise of robo-advisors, online investment platforms, have you guys run into any challenges or hurdles in terms of differentiating yourselves from, these services and what they offer, like for instance, fund managers or managed funds, and what they offer to their clients? Because there is those options now with Vanguard where you can just put your money
Personal
into a
investment.
managed fund and some, yeah. So is there any challenges you face there in terms of what you can offer your clients that these, funds already are doing?
I'll let you take this one, Aadil.
I think that's a great question, Hayden. I think we go back to the original idea, which is that financial planning and what we do is not for everyone. In fact, we sometimes would actively say to certain clients, you're not ready for us. In fact, the robo-advised model actually may be good for you at this stage of your life or your investing journey. So it could be linked to your life stage or what you're trying to do. It could be linked to your style as an investor as well. It may be that's better for you. Financial planning is an investment of not just I would say money, but it's also about time and energy. So if you're looking to invest money, time, and energy and work with a coach, that's when we become relevant. If you're looking for something which is much more like a simple version of investing, then these are very, very good tools. Everybody should get financial advice in some form, we believe. What form they get it, be it through robo-advice, through just directly talking to fund managers, or by working with a financial planner, it's for individuals to try and determine. So we don't see them as competition. In fact, we see them as educating people on the value of advice.
I totally agree. And sometimes it's simply, one example is like tax efficiency and structuring. You might be doing the right investing via Vanguard Personal Investor. It's a great product, and there's other similar ones as well. But we can show clients, that's part of the work that we do with them, is that once we're clear on the goals and whatnot, there might be certain structures that you could invest exactly the same way that you're doing in your own name, but you pay less tax. And so you're not taking any more risk, but you're putting more money in your pocket over time. And so, that's a key part of the work that we do with people, is getting things properly structured. And it doesn't necessarily, some structures we're talking about are companies and trusts. They're the traditional ones, but other less traditional ones, well, they've been around for a long time, but they're less well known, is structures like investment bonds. So they're a great vehicle for higher income earners to invest through, because of the unique tax advantages that type of structure offers. In some respects, your tax rate can be in the single digits investing through those vehicles relative to higher tax rates investing outside, depending on the type of investment you do within that structure. But just as an example, it's like, before, as part of the investment strategy recommendations, we're also giving the structures through which we recommend they invest that money to as well.
So the next topic that I want to chat about with you guys, you've provided some really good insight so far. I know that disclosing, specific advice related to investing in different ETFs or stocks or whatever it may be, it's the rules and regulations in Australia are very, very strong, just as they are with like the TGA. And Australia's very, very harsh on financial advisors, but with as much as you can give, with regard to the core and satellite investment account approach, which I know is endorsed by a lot of financial advisors,
and by us,
and by you guys, sorry.
Yeah, we do.
Yeah. But can you just talk before I give a bit of a talk about my own kind of opinion on that? Do you want to just talk more broadly about what the core versus satellite account approach actually looks like and how it would apply to a investment fund?
Yeah, great question. And it goes back to that analogy we're using before around dieting, that there's many different styles of investment strategies and they all can work if you stick to them. And so I guess in explaining a core satellite approach is that the core part of your portfolio is more static. It's typically invested in a diversified portfolio or like a Vanguard growth fund, or it could be just a pure index ETF, like some of the ones that you mentioned earlier, Vanguard Australian Shares. And it's kind of just set and forget. It does its job. It's done, and crucially also, it does it at very low cost relative to other sorts of investments. The satellite can come in so many different forms, but essentially it's the more active part of the portfolio. Our style with that is we draw on long-term market cycles research to identify certain themes and assets that have a tendency to perform well at certain stages of the cycle. So we'll seek to construct satellites that are made up of thematic ETFs and fund managers that perform well in certain asset classes. But really, in some regards, satellites can be whatever you want them to be, whatever suits your style of investing. But by definition, it orbits around the core. The core stays pretty much the same through the journey of your investing, and the satellite is where you're making the more active changes along the way as you're responding to changes in the market.
Yeah, so I guess what you're saying there is it's like your core is kind of like the set and forget.
Yeah.
With your regular dollar cost averaging, and that satellite, you're a bit more open to risk and
the fun part.
Like to have a little bit more fun than you should. Yeah.
Not necessarily more than you should. It can be a very important, relevant part of the portfolio, and we implement those strategies for clients that value that.
So where I was getting at with I guess how stringent the Australian government is with regulations around financial advisors and the information they provide. This relates more so to the actual brokerage accounts that people are using to set up these core and satellite accounts. I'll give a bit of my own anecdote here just to help anyone out there who's starting out and maybe will experience similar hurdles. But for instance, with CommSec, they have a Com Pocket option, which you can set up those kind of residual payments over time, dollar cost averaging into various different thematic and some index ETFs like IOZ and so forth. But the CommSec itself, there is no option to set up multiple accounts, and you can't set up those ongoing investments that happen in the background without you really having to do much. So for me, one way that I've done it is I'll get an amount that's deposited into like the CDIA account, say every fortnight or month. And then that money that's deposited is based on the amount that I'm reinvesting into those index ETFs.
Sure.
So that's one way, I guess, you can do it. But that on my part requires a little bit more, me actually moving the money as opposed to it actually happening automatically. So, but I just want to keep all my money through the Commonwealth Bank. So is there a better way or another way to do things through another, say, brokerage account, whether it be CMC Markets or any others that, I'm not sure how much you can recommend in this respect, but, is there any way you would recommend for young people to get started with that dollar cost averaging?
Aadil, or do you want me to do this one? Or?
I think I can give some insight into this. Dane comes more from this world of sort of active management, so of course he'll have really good insights into that. Again, I have to be mindful, as you said, about the regulation, what we can say here and what we cannot say. I think it's from my own anecdotally, I can say that if people are looking for this, looking to get started with this sort of a core satellite approach, to try and check out, I would say, robo advisors like, I would say, StockSpot. Like that's the one which we've heard anecdotally about. Many of our young clients who come to us have a portfolio there. So we've seen that people have gone down that path, and they kind of do a good job of constructing a portfolio which is of low cost index funds.
Sure. And I guess that's a great tip, Aadil, and maybe another potential angle too is there's many investment platforms out there. Some require an advisor, some don't. So it depends on the nature of your self-directed. Obviously, you'll need to find platforms that allow you to do it without an advisor, where you can set essentially the percentage allocation for each of your investments. And so as new money is coming into the portfolio, it's automatically being allocated to those investments. So rather than you having to physically buy each time you've got putting more money into your CommSec account or whatever, just to throw it without sort of, there's literally dozens out there, but your Netwealths, your Hub24s, your Premiums, Macquarie, your BT Panoramas, there's plenty of platforms out there that they're a little bit more expensive because they're doing tax reporting and they're enabling some of these investment automation that's not necessarily offered just by a pure transactional broking platform. But to answer your question, Hayden, that would be a way of exploring sort of a more efficient way to do what you're trying to do.
Yeah. I think that was the thing. It was just a bit more expensive and I just want to keep it all in one spot, but definitely something for me that I'm trying to improve that process. Yeah.
Comes down to what you value, because that's what you're paying for. You're paying for that efficiency. You're paying for tax reporting to be done for you, so you're not having to collate all the dividend statements and whatnot. So there's pros and cons. We're not saying one way is better than the other, and it's how much you value your time as well, in terms of what you're paying the platform to do for you versus what you do yourself.
So there's also the ability to reinvest dividends. And one thing I do with use the satellite account for is, say, investing in like a small cap. And if you make back the money that you already invested into that small cap, say maybe sell half those stocks, reinvest that back into the exchange traded funds, and then leave the other half of the small cap stocks there, so that overall you have a net have net growth as opposed to, set and leaving it. It could be lithium where the prices went up quite high recently with the demand. And now that demand's kind of fallen away, a lot of those small cap lithium stocks have really hit the floor. And so a lot of people have lost a lot of money in those
Let's
circumstances.
drill into that part. I'd like to, if that's okay.
Yeah.
Because that highlights a really key point around people exploring thematic ETFs. There's a bit of a, there's been some good sort of news articles around this recently with different viewpoints. Is that particularly new investors are excited about the theme, and it goes back to something I mentioned earlier in our conversation. Is that if it's in the news, it's in the price. Lithium, battery metals, all of that sort of energy transition theme was a very popular theme there for a while. It was exciting. It had, the rivers of gold were coming, but it was well known and it was factored into the price for that period of time, and it kind of got ahead of itself. And we saw what happened after that. Now, as you pointed out, there's not so much talk about that at the moment, particularly in the lithium space and whatnot. It's pulled back a bit, and that's been reflected in the decline in prices. And so, when you're exploring themes, you try to go beyond sort of the first level thinking. Is that just because it makes sense doesn't mean it hasn't already been factored into the value of that. You've got to continue to look for things that are kind of less popular, I guess, at that point in time, but still have enduring value over time. If that makes sense.
Yeah, when you look at the index ETFs too, like some of the examples we spoke about before, like S&P 500, IVV, the iShares ETF, or the Vanguard Australian Shares Index. They're a lot cheaper, right, with the fee compared to a lot of these thematic ETFs where you can pay 1% to 3%, which, like, if you look into them, like the beta shares, sustainability leaders, was like one of the example of one of the cheaper ones I've been looking at a lot recently. But there's also, for those thematic ETFs, they seem to be a bit more expensive as well. And so, and they're more, you have to be a bit more risk averse as well. Like with my means of investing, as you say, is like more the index ETFs. I would put my thematic ETFs in my satellite account because I think there opens more risk. Say investing in some of the ETFs associated with lithium. I think like ACDC, for instance, would be an example of one. Not saying that investing in any of these, just as examples, but sustainability leaders, ACDC, for instance, like lithium, sustainability. Maybe you go and invest in tech, whatever it be, maybe cybersecurity or whatever it is. But if you're investing in, say, the A200 or VAS, you've got exposure to the top 200 or whatever it be companies on the ASX.
Very low cost.
And a lot of those companies may be, say, sustainability within the sustainability leaders, or maybe cybersecurity, like Tech One or something. So you get exposure to those, but you get more diversification, which reduces your risk profile, which is one of those big messages I think that would be good.
That's a great point. Yeah. That's a really great point. And a tip on that, I guess, is have a look at the fact sheet before you invest. I mean, that might sound fundamental, but people often jump past it. To your point around have a look at what's under the hood, because every ETF has a fact sheet that will list the top 20 or so holdings that particular fund has. So to your point, you can look at A200 and you'll see the top 20 or so stocks in that portfolio and the percentage weighting that they have in it. Then compare it with an ACDC, or a lot of those thematic ETFs give you access to investments that aren't Australian based. So they can be good diversifiers, and it can be worth paying a premium to get that diversity if it's a theme that you feel is going to have a tendency to perform well. But by looking at the fact sheet, you can see, there's a lot of different investments here in this one. So that's going to be a good diversifier from the A200. That's your BHPs, your Rios, your banks, your Telstras and whatnot that might be in industries that, and then this isn't me expressing a view on that, but they might be in industries that aren't part of the theme that you want to have specific exposure to. And I also absolutely agree that thematic investing should be part of the satellite, not the core. Because the core is kind of tied to, I guess, the habit formation that we talked about earlier.
Yeah, and it's more tied to a specific niche in the market, right? And if that, say, like one of the reasons I think that tech stocks, for instance, would be really good during, say, COVID, because everyone was working from home and tech really had that growth. So yeah, definitely something there for a lot of people to think about. I guess winding things now towards the end of our conversation, I want to talk about a lot of what we've talked about is growing wealth and good habits and own your own financial planning, obviously. Pardon the pun, but yeah. So now coming to the back end of your life, I guess, what are some of the common mistakes you see with people planning for retirement? So I guess it's a lot more different in this circumstance. They're investing more in bonds, less risky investments. They're looking at moving super around. Yeah, how do you see, or where do you see the biggest mistakes in this area?
I think this one's definitely yours, Aadil.
Sure. So biggest mistakes at the financial level, I would say, Hayden, when it comes to retirement planning is, first of all, not having a good understanding of what your retirement lifestyle is going to cost you. People just don't have an understanding of what it's going to cost you during retirement. What are you going to do with your money? So having a retirement budget, so to speak, because your budget as it is right now may not be the same budget as you need in retirement. So that's one thing. Secondly, not paying enough attention to, I would say, super. Like that's a very, very, I would say, common one. People just tend to not pay enough attention to it in advance. Super is one of the best financial structures we have, I would say, not just in Australia, but globally. It's one of the greatest Australian inventions, I think, is our superannuation system. It's something to be very proud about, as much as we can sit here and talk about it, about how all the challenges with it. And then thirdly, and I think from a retirement planning perspective, it's the third thing is understanding that during retirement, ironically, your income can come from different sources. Like for all along when you're accumulating assets, you have one source of income, which could be your employment or your business. But when you're in the retirement phase, you could get income from your investments, you could get income from part-time work, you could get income from the age pension. There are so many income sources, and not maximizing the income sources to fund your lifestyle, and not having the concept that, you know what, it doesn't all have to come from one investment. So thinking about retirement, holding investments in the right structure, maximizing all the different things which are from an income source perspective to fund your retirement lifestyle.
Yeah, I think we have to reiterate Mark Bruce's sentiments about how thankful I think we all are to the Keating government when they introduced the superannuation in the 90s. What a great thing for all Australians to be able to, retire from work and have this little nest egg of money to set up and travel and do all the great things that you guys have talked about that, the own financial planning is all about.
It's great self-determination, because if we had the choice, would we be putting aside 11% of our money to something that we can't access for 30 or 40 years? Probably not a lot of the time. So that forced savings habit look, we can have different ideological philosophies around it, but the proof's in the pudding. It's a multi-trillion-dollar pool of money that's just a result of regulation that probably wouldn't be anything like that if people were left to their own devices. So I obviously don't want complete government control over what you do with your money, but I think there's a lot of sort of irrational negative opinions without taking a view on either side of politics. Sometimes there's some irrational perceptions about superannuation in general, that it's this is government football. Yes, in some respects, there's been changes over time to the taxation treatment of super. There's one coming up later this year that's going to have a significant impact, but it's still a structure that is highly tax efficient relative to investing outside of it. And to Adil's point earlier, it's one that in our 20s, 30s, and sometimes even 40s can have a tendency to be ignored, except during that period of COVID when you could pull $10,000 out and do what you want with it.
Well, you can have a self-managed super fund though, like there, and you can pull money out if you struggling to get your first property. I think it's just in general, it's a good structure for saving. It's doing what a lot of people can't, which is developing discipline with their saving. Instead, you've got this barrier where you've got to cross where this money just residually goes out into your superannuation.
Yeah. And to Adil's point on that, yes, that's great that structure's in place and money's going into it. It's paying attention to it and seeing that as your money and seeing that is it's part of the pool of funds that is building towards that desired retirement lifestyle. And call it sort of, we kind of prefer the term work optional lifestyle to retirement, because I think the nature of the concept of retirement's changed significantly across generations. Is that you're going to live for another 30, 40 years potentially beyond the official retirement age in Australia. It's a fairly significant part of your life. Whereas the entire retirement system was built around, it was built in a time where life expectancy was 66, 67 years. You retired and then you lived for a couple of years and you died. So making sure that you really think consciously about the things that you would like to be doing if you weren't working, and then making sure that you've got an investment strategy working towards achieving those outcomes, so that you're balancing the present with the future, that you are still enjoying life along the way, instead of getting to retirement and going, well, what do I do now? It's having that sort of clear picture of what you would like to be working towards it, and is as important as how you invest the money.
Without getting political, do you find there's a certain type of character which generally is against the superannuation when you're talking about moving money around?
And it isn't necessarily one side of politics. It's I'd say it's just one of the many limiting mindsets that sometimes people have. It's like an easy thing to have this bogeyman that, the government's going to take my super away, or the government's going to do this, or powers that be are going to do that.
Pessimistic,
It was just an easy excuse to do nothing, is to blame some vague concept of, well, like, I'm not going to pay attention to super because I can't control it, I can't access it. Now the government keeps changing tax rules and things like that. All of them are just convenient excuses to avoid taking action. I feel very passionately about it because it annoys me. It just annoys me that people get in, because I know I've been guilty of versions of it in the past in my own life. Is you just get out of your head and just take action.
We live in a pretty good country, and whilst things are really tight, you got to feel
absolutely.
That's why so many people coming from abroad to live here, like yourself, Aadil.
Absolutely. For me, I was about to say, I'd jump in there and to say, it has been the best decision of my life moving to Australia. Like, yes, I did come from a background where I could have had a lot of choices in my life, but this one single choice which I made to move to Australia, I think I still consider that to be the best decision of my life.
I reiterate those sentiments, and I would also like to jump back to, I know an episode that you really enjoyed, Dane, was the episode with Gaj Ravichandran. Yeah. Talked about that growth or abundance mindset, which was something you had to develop early in life.
Mm.
How have you guys integrated that into own financial planning, that abundance, I guess, mindset or outlook?
I think fundamentally it's our starting point is we focus on
basis.
Yeah, that what's important to you? What are your values? Not just by asking the question, what are your values? Like, we've got tools that help draw that out and people can answer that naturally. And then we tie that to, what are you trying to achieve? Like, what would your life look like right now if you're doing everything that you wanted it to do? And so without putting constraint, without putting at the early stage, without putting constraint on that, go, oh, I can't do that because I haven't got enough money. Well, let's at least start with what you want and then see what's possible with a well-structured plan. So we don't necessarily know in advance of doing the work what's possible and what's not. And sometimes there might be trade-offs in terms of goal priorities and whatnot. But that starting point is at least have the view of that optimism that if I work towards something, my life is going to improve as a result. I'm going to feel better because I've got a purpose, as opposed to, you know, indulging the anxieties and the fears or the resentments and whatnot, or living too much as a victim of your past. Is that you can't control where you've come from, but you can control the actions that you take in the present to have a better life today and tomorrow.
And one of the other things we do, Hayden, is essentially, I think, where we kind of start giving people an idea on the growth mindset is showing them that you can strike a balance between enjoying the present and actually creating the future. A lot of people come with that scarcity mindset that I have to actually compromise on my present to get to the future. I think a growth mindset allows you to, like, by showing you that balance of striking that balance, it automatically gets people to think, okay, you know what? It is possible. I can have a growth mindset towards my present and the future.
Really great insights there, guys. And I think one of the things that I am interested in is now understanding a bit more about where you guys actually get your latest financial information about trends and changes and regulations that will best serve the listeners, but also your clients. Where's your kind of one-stop shop for information?
I would probably answer there isn't a one-stop shop, and I'd say, and I'll probably sound like a broken record, that whatever you're interested in, you'll get something out of. So explore that scientific or that natural curiosity that you have, and whatever resonates with you, indulge it. But for myself, I'm a keen enthusiast of long-term market cycles research. It's kind of a little bit off the beaten path. It's not for everyone. But there's a group called Property Share Market Economics. That's their website, which actually goes back to one of the points you made earlier around shares versus property. In a sense, one market reflects what the other is doing, and the more you understand about the share market, the better you are as a property investor, and vice versa. So I really like their work, and one of their directors, Akhil Patel's written a really brilliant book around how to practically invest through the various stages of the cycle. And when we're talking about a cycle, it's 18 to 20 years roughly in length. And the starting point for our current one was kind of the end of the GFC. But the GFC wasn't exactly a one-off event. You can look back through history, every sort of 20 years or so, there's a major event like that. And their research talks through, I guess, the causes for why there is a cycle in the first place. Why does it repeat? And a lot of it comes down to the financial system as it's structured and human behavior in general, that we don't have a tendency to learn well from the past because each generation really starts anew, and doesn't necessarily experience some of the conditions that have propped up in previous cycles. They just change in form, but the nature of how it plays out is quite similar each time. But Aadil's comes from a very different perspective. So you want to share your thoughts, Aadil?
From my side, Hayden, just two particular newsletters which I subscribe to, which I find have been very valuable for someone like me who's not really interested in each particular stock or not interested in particular themes, but just wants overarching principles around things. One is, I would say, Livewire. So the daily newsletter sort of put out by Livewire, where they interview different fund managers. They talk about themes. I find that very particularly interesting to get to learn. And the second one is First Links, which was a newsletter started by Chris Cuff, who used to be previously at, I believe, at Yeah, exactly. Over there. So those are the two newsletters which I subscribe to. I read them all the time. I kind of absorb the key learnings from there and the themes from there, and I found them very useful in my own journey.
Very good. I'll have to have a look into those. Okay, and the next thing I want to maybe just discuss a little bit about is if you've had any client success stories or case studies where you've actually helped an individual transform their life. And when I say transform, it may not be making them wealthier or richer necessarily, but freeing up opportunities to live a little bit more.
We've got a quite range. I'll share one, and maybe Aadil, you want to share your own version. To your point, and it's not necessarily the most money that any client has made or anything like that, but how someone's life is transformed just by changing some simple habits. One of our clients was at had a lot of bad money habits. They had credit card debts. They had they were spending more than they earned. They were gambling. All of the the things that hold you back from achieving sort of sustained success. And the first, he was clear that he wanted to change. So he had an intention. His mindset was ready to actually benefit from advice. And so, we just looked at everything and just put in place some very simple habits to go, okay, let's restructure your cash flow so that you're actually putting money back into your pocket first. So we did a budgeting exercise, and it wasn't easy for him, but he stuck to it. And over the course of 18 months, he went from being 30 or 40 grand in debt to having enough money saved up to buy his first investment property. And he did that through implementing just some simple investment habits with the surplus savings he was going to be able to generate. He was able to generate after he first paid off that credit card debt. So that's on the smaller scale in terms of numbers, but in terms of the impact that it had on his life, it was transformative. He felt more self-confident in himself. He had a clear plan as to where he was going, and he had developed the habits that were going to achieve sustained success. And that's going to be, over the next decade for him, is going to be worth a lot of money to him, having put that in place.
Very good. Aadil, any experiences, stories?
Just one which comes to mind, Hayden, is recently we had a couple who came to us who had significant, I would say, wealth and assets, and were looking to start changing how they lived their life, wanted to have options in their life, wanted clarity around, can we achieve that? We've done all this work, we've got all these assets, all this income, but we can't seem to have the confidence that we can go and live the life we want to lead. They felt they had to continue working 5 days a week, or like be in those high pressure jobs, and they wanted to kind of get clarity around that. So through the work which we did for them, it kind of became very apparent, and we gave them that clarity and the confidence they needed to say, you have choices which you can actually activate today. It doesn't have to wait for another 10 years. You don't need to buy more assets. You don't need to do anything more. If you stick to your current strategy, the validation that what you've done is great, it's already great, it's going to serve you well, and showing them through a numbers and through some scenario planning to say, you actually have options starting from tomorrow. You don't have to wait another 10 years. And that was a great transformative experience for them, because you could all of a sudden see that now they're starting to make decisions around their life, which we had to start making decisions from now itself, and which they valued very much.
Just put some metrics around that, like some of the interest savings just by restructuring their debt as one part of the strategy was going to pay off their home loans 6 or 7 years earlier than they were on track to do, and that's going to save them 6 figures of interest savings over that period of time, just simply by changing some habits. They had good savings habits. It was just redeploying that in a way that was going to bring forward many years the goals that they were trying to achieve with their lifestyle, just by making some changes as to where they deployed that cash flow into debt reduction.
Very good. No, it's nice to hear that too, because there's all these other different ways to save money, often indirect ways that people don't think about. It's always about
Yeah.
the property, the shares, but no one really talks about things like income, like we were talking about, income protection insurance, how you use your super, interest with, where you put your money, whether it be in an offset account or in your savings account, and it's like a false economy in that sense, dispersing your funds. So I think in that sense, really, really wise for anyone out there that is unsure to actually get in touch with you guys or another financial advisor to help clarify things early on when they have the potential to have the greatest impact on their future, right? We do have some questions from some of the listeners.
Hmm.
So the first one is tips for saving.
Hopefully none of them are about leg spin.
Oh, mate, I tell you what, we got
How do
one.
you land a good leg break? I haven't done one for 20 years, so most of them full tosses and long hops since then. So I can't help you with that.
Oh, mate, I tell you what, there was a question regarding Zach Lomax.
Exactly.
Do you see that on Brad on Facebook? Do you see his
Could buy in Supercoach.
Yeah. What do you reckon on the couple
Well,
million?
he's certainly applying good habits to his footy at the moment. I mean, he was in an environment that he wasn't happy with, but on the field, he's doing what the coach wants him to do, and he's getting results. So if we're going to use that as an analogy, that's all it takes. Some simple changes in mindset and habit, and now he's on the cusp of being picked in Origin.
Yeah,
Same applies in the money world.
Fantastic. And I think one of the things that I'd say is that it really pays to stay updated with information and reading and learning, continuing to learn, because, for me, I was really invested in the NRL probably 3 years ago, 3 or 4 years ago. You watch a lot of the games and pay a lot of attention, but since it got busier, I've kind of just dropped off really. And so we had a bit of a super coach or a draft. We did this the start of this year with a couple of my friends, and here I was thinking I got all these good buys: Teddy Tedesco, Jerome Luai, Brian Tohu. It's been pretty good this year, but I just got all these players which I presume were in form, but really, I haven't stayed up to date with the information. So if you wanted to start drawing parallels between football and sport and the economy and finance as well, it pays to keep educating yourself, keep reading, keep learning, and keep developing your savings habits too. So,
I 100% agree.
in terms of the next couple of questions, we just got a few that are related to more specifics. You probably can't provide too much information here, but I'll just go through those anyway. But we've got a question. Someone wants a silver bullet here: VDHG or VHY, which is best? Well, they're completely different in what they offer, aren't they? But in my personal opinion, you'd probably say that VHY is more towards dividends, but you probably, if you're early in life, you don't really want to be paying all the tax on the dividends. It'd probably be, again, like a false economy. You'd prefer to put your money into DHG. What are your thoughts, guys?
So and forgive me, I don't know every single code on the ASX, but from memory, VHY is the high yield.
Vanguard, yeah, sorry.
Vanguard
high yield. And then VDHG's Vanguard diversified high growth.
Sure. So maybe it's better to answer that in explaining along the lines of where you were going in terms of the features of what you should expect to get from that sort of investment.
Yeah.
So Vanguard high yield, and correct me if I'm wrong, but my understanding is it's a portfolio of high income earning shares. So by default, those sorts of investments are slightly but less volatile than the market itself, and more of your returns going to come from income than from capital growth. You're still going to get some capital growth, but not as much as the market itself. So to your point, typically that's more not necessarily age based. Let's go back to the goal. If your goal is to live off the investment, maybe an income strategy might be suitable. But so it's thinking about it's thinking about the purpose of what you're investing. Think about the purpose of why you're investing as to what the right investments are for that strategy. And then remind me again, sorry, Hayden, the other ETF that was mentioned.
Yeah, so the VHY, which was the high yield, which is
Yep.
for dividends predominantly.
Yep.
VDHG, which is Vanguard Diversified High Growth. So I think
Yep.
they're investing a lot more those low mid cap stocks, which have potential
Sure.
for high growth in the coming years, and it's a lot cheaper and more affordable for young people
Sure.
to invest in.
So I'll challenge you on the more cheaper or affordable, unless I've missed the context of that point, is that let's say you got $10,000 and the unit price of one of those investments is
Yeah.
$100 and the unit price of the other one's $1. All that really means is how many pieces of the pie that you get. It's still
How many
the same
units?
$10,000 going into either one.
What I meant by cheap, I think, was just the fees. So
Gotcha. Okay,
percentages.
sure.
That's
Yep, and that's a very valid point to focus on, is that fees are a friction cost, and it does influence the return you can achieve. Obviously, it's what's on the tin. It's a high growth investment strategy. It's identifying companies that have a tendency over the long term to perform better than the index. However, it comes with greater volatility typically as well. So you've got to be able to stomach. Um, Investing in the share market in general is volatile. We're talking about the nuances of different investments relative to the index itself. So it might not be and this is often the case. Our viewpoint on this isn't necessarily the answer someone's specifically looking for, but we feel like the right context is, well, what's the purpose for your investing in the first place? That determines what the right investment or investments are. That's a more long-term growth-focused strategy than what VHY is going to give you, which is more immediate sort of income generating. In speaking very high level and generic as to sort of what the different features are of those two ETFs.
Yeah, I guess I haven't gone into VDHG, but I think Vanguard is soon opening up the ability to adjust the proportion of stocks they hold within the ETFs or the managed funds, sorry. But I'm not in VDHG only because I prefer to build my diversity in a portfolio myself through indexes. Yep. I think the VDHG is a good option for people who are unsure and they want to get exposure to some of those, as I said, like smaller cap stocks at a relatively low percentage in terms of that fee we're talking about that they're going to pay, but also doing so in a manner where they've got these units that are exposed to all these different small mid-cap stocks.
As a theme on that point, Hayden, at the very strong risk of expressing a market view, if it's of any relevance or appeal to your listeners, is one thing that we've identified, and it's reflected in our satellites, is both emerging markets and small and mid caps, both domestic small and mid caps and international, at the moment are trading at historic valuation differentials to the larger caps. So you may be familiar with the Magnificent Seven trend, that the seven largest companies in big global mega cap companies in the US have been the main driver of share market growth over the last sort of few years. That's created quite a significant disparity in performance between smaller companies that traditionally small caps and mid caps perform better than the large companies because they've got greater capacity to grow and reinvest their earnings. So it's an area of the market that we like, and likewise emerging markets relative to developed markets for similar reasons, is that all markets grow at different times in the cycle. It just happens to be at the moment, small and mid caps, emerging markets have been through a tougher period, have been flatter in their growth trajectories in the last few years, may have the potential to outperform the larger companies over the next few years. All, without being able to predict the future, just looking at history and just seeing that there's quite significant valuation differentials between those markets.
How many exchange traded funds is too many?
You want to take this one, Aadil?
How many exchange traded funds is too many?
I think the answer to that is it's about, I would say, diversification from my perspective. Like if you're reasonably well diversified, then that's where you stop. And it depends on how much diversification you want in your portfolio. Diversifying for the sake of diversifying and chasing themes is probably not the way. Like people end up having different exchange funds or building that portfolio because they feel they need to have every theme in their portfolio. It's, I think, rather, I would rather say from a portfolio construction perspective is like, do you have uncorrelated assets, diversification, use those principles, and you'll be able to determine whether it's 5, 7, whatever it might be.
Do you need to dabble in, say, Europe, the UK, Asia? Is it enough to have, S&P 500, ASX 200, and maybe some exposure to something like IOO or global quality?
All of the above. It's not the answer that people want to hear, but really, it's start with the simplest thing possible. If you absolutely starting out, aim to start with, to Aadil's point earlier, start with what you understand, and the big sort of some of the ones you mentioned, VAS, IOZ, etc., are giving you broad exposure to the Australian share market. And then you've got things like VGS, which is Vanguard's International Shares ETF. iShares have got a very similar version of that as well. If you have a view on the currency and you want to invest internationally, but you don't want to take the currency risk, iShares has got IHOO, for example, that gives you broad international exposure, but hedges it back into Australian dollars. So you're getting the investment performance of your international shares without the currency risk.
Okay, awesome. And the last one, this is the last question, I think a quite a relevant one because everyone talks about bonds, but a lot of people don't actually know what they are. What are bonds? How do you use these in your portfolio? And there's a couple here that I've bought into, and gold and that kind of thing recently, which I'm finding is actually a positive thing. Gold prices are at an all-time high. There's obviously that seesaw you kind of get where when the bonds go down, the share market's coming up, and then vice versa. So when we have that market crash back in 2020 around COVID, you'll see that the bonds go up to kind of
they can, but not all.
Save your income. Yeah, not all the time, but that's kind of like the rationale that I have.
Yeah, and it's not. I wouldn't say it's far from the truth, but I think there's some context within it. The devil's in the detail always. I'd say that to address that part of it, yes, bonds are uncorrelated to shares in some regard. What are bonds? Essentially, the easiest way to explain bonds are, if you've got a mortgage, essentially you're on the other side. So the bank has a bond that's generating them an interest payment. You're the one that's borrowed money from the bank. You're paying that loan back with interest. That's essentially what a bond is you, the investor, lending money, could be to the government if it's a government bond. It could be to corporates, big global companies that need to borrow money. And so the return that you receive from bonds is the capital you get back at the maturity date of the bond, plus interest. So unlike shares, where as over time, as earnings grow, the value of those shares increase, and that can increase indefinitely and exponentially. Bonds are more fixed in the returns that you can expect to achieve from them at one level, where you can get the potential for capital growth from bonds is essentially inversely correlated to the direction of interest rates. So over the period of time where you mentioned earlier around when interest rates were really low, and then went up quite significantly in a short period of time, that's a very negative environment for investing in bonds, because the value of the bonds is reducing as interest rates are increasing, because the price that you've paid and the interest that you're going to get is much less than what you're going to receive from new bonds at the new interest rate that's in place. Conversely, on the other side, when interest rates are falling, the value of bonds can go up. They are lower volatility than shares, so they can be a way in creating a more defensive part of your portfolio to reduce the overall volatility of it, if that's important to you as an investor. I guess to the point I was making earlier is it's not necessarily as simple as when shares go up, bonds go down, and vice versa.
Yeah.
And we saw this in 2022, where that was one of the rare markets where all assets were going down at the same time. Bonds were going down in value, shares were as well. That was a very tough year to do well in markets. And then there are other times where interest rates are going down and bonds are going up in value, and the share market's going up in value too. So it is one part of the overall picture, but I would say that they are just uncorrelated rather than necessarily working in opposite directions.
Okay. Awesome. Well, the last thing we have to do, guys, is a bit of a formality, is get your additions to the Normless playlist. So are there any songs that you've been listening to, when you're at your desk scribbling away? Are there any songs that you might have been listening to recently, Aadil? Going home to see family on the plane or whatever it be? Dane, getting you through your work days and the drive home. What's been in your ears?
You go first.
Mine, I'd say, is this song has been like an earworm for me for a while, is Sweet But Psycho, Ava Max.
Oh, yeah, Sweet But Psycho.
Describes me a little bit, I think.
Mine may be somewhat of a surprise, but I certainly I don't listen to music when I'm working because I'm prone to distraction, and so I need quietness. Sometimes I might listen to classical music, but the irony of this is if I want to listen to music, it'll be 90s and 2000s R&B hip hop playlist. That's sort of my go-to. My go-to. So not particularly productive at work times, but any of my mates or friends listening will know exactly exactly what's going on there.
Any particular artist, or you just want me to pick something at random?
Park, Hit 'Em Up, Biggie, Lil Wayne, all the classics, Eminem. Like my era for that was sort of late 90s, early 2000s. So 50 Cent, G-Unit, anything from that era.
What about Hate It or Love It?
Yeah, Underdogs on top. Love it.
That's how we're going to go out.
I love it.
Underdogs on top.
There we go.
Thanks, boys. Own Financial Planning for Normless Performance, episode 3. I had a pleasure, guys. Hopefully there'll be plenty of insights there the listeners will enjoy too. So thanks for your time.
Yeah, thank you, Hayden. Thanks for allowing us to share our story.
Thanks for having us, Hayden. It was great to chat with you.